Talk about the fickle finger of finance. For most of the past year, especially the second half, BHP boss Marius Kloppers wasn't exactly flavour of the month. There'd been a series of expensive but never completed mega takeovers in previous years that cost shareholders a fortune. And the company's focus on investing for the future rather than delivering to shareholders now had done the BHP boss no favours. Then, to cap it all off, the one big takeover that had been bagged, a $20 billion plus purchase of American shale oil interests, had to be written down when LNG prices in America plummeted. Now, if you thought things couldn't get any worse, you'd be mistaken. China's slowdown then saw iron ore and coal prices hit the skids. So the resources boom was read the last rites and pretty much everyone wrote off the miners. But that's when the big Australian went to battle stations. A couple of huge expansion projects like Olympic Dam and the Port Hedland Harbour expansion were shelved, and difficult or second-ranking projects were offloaded. The focus suddenly was on costs and on delivering better returns. And just when this tighter cost regime started to kick in, the leadership changes in China were out of the way and China's recovery was back on track. So in the lead up to Christmas, commodity prices headed north into far more comfortable territory, and when combined with the asset sales and the tighter cost controls, BHP suddenly found itself the welcome recipient of amorous overtures by investors. Even the shale gas play scored some decent headlines. When gas prices plunged, the BHP team shifted the rigs from the gas fields to the fields with a higher proportion of oil. Again, that limited costs and provided some extra revenue. The broking analysts began singing the company's praises once again, and investors have begun to move back into the big miners. Now, given its diversity with minerals and energy, BHP has resumed the mantle of being a stock market favourite, and Marius Kloppers is back in the good books.